welcome to Global Mantra, a special show that profiles prominent fund managers from the City of London and gets their views on the global market situation. Joining me on the show right now is Nidhi Mahurkar, who's the head of Asia ex-Japan long-short equities at Pictet. Pictet, of course, specializes in investing in emerging markets and their Asia exposure or the total assets that they manage in Asian equities is in excess of $5.5 billion. Nidhi, it's great to have you on the show. Thanks very much for taking out the time. Nidhi, just give us a sense of the long-short fund, Asia fund that you set up about a few months back.
Well, we launched Pictet's Total Return Banyan Strategy Fund in November 2011. And this is an Asia ex-Japan focused long-short equity fund which invests on a pan-Asia basis. The strategy actually has been in existence in Pictet for the last 10 years. It's been seeded by a sovereign wealth fund who's really been with us since inception, about 10 years ago. And the essential idea in terms of what we're trying to achieve basically is to provide returns that are better than the market on a risk-adjusted view, i.e. lower volatility than the market. If you look at Asian markets over the last 10, 15 years, while the empirical bias over the long term is upwards, and that dovetails with the comfort that we have with the macro story of Asia, the secular growth opportunity that it provides, but the region is periodically witness to periodic crises, and you see astoundingly large drawdowns. The Achilles heel for the region, I think, in times of stress is that the investors who own it are not domiciled in Asia, and so the transmission mechanisms whenever there is global stress is through trade, through fund flow, through direct investment flows, and you see very choppy, big drawdown types of environment. So in that context, despite the growth differential that the region offers you, we believe embracing a long-short equity framework enables you to provide more consistent returns than the market overall. So that's really the essence of the strategy.
In that sense, do you think that the style of investing in Asian markets has changed?
I think it is a growing trend, and it's a rising tide in terms of the number of Asian hedge funds that you see in Asia ex-Japan today, which I think easily exceed over 500, though not many have achieved critical mass. Some may not want to, and they operate in niche strategies. But absolutely, I think a judicious process of risk management rather than just buy and hold long term is viewed to be a better paradigm to enable investors to get an acceptable rate of return and minimize that volatility drag. So in our opinion, the region continues to offer secular growth opportunities which our strategy seeks to exploit. Our product, basically, the portfolio is the product of our quantitative models as well as our judgment. So exploiting stock picking skills together with risk, which we know well. And what that does, exactly as you said, is it enables us to have the flexibility to vary our exposure. So structurally, we would say that we are long biased, but we would basically have this freedom to vary our exposure, vary the gross and the net, depending on the level of directionality that we desire, the opportunity set that we see, and our assessment of the global risk.
What would be your return expectations from this kind of an investment philosophy? How would it differ from a pure long-only philosophy?
What we say, I hesitate to give you or predict with confidence an exact number because we don't believe in giving market forecasts, but what we would say is that we would aim to aspire to achieve 75% of market returns in equity-friendly environments, so an upside capture, if you like, of 70% and downside protection of about 30%. So this is not a strategy that will be up if emerging markets or Asian markets are down 25%, but we look for that 70-30 capture, which if you look at returns over time, when you compound those returns, deliver a much better risk-adjusted profile.
What about your stock selection process? How do you go about it?
We have stuck to our core beliefs in terms of our fundamental stock picking framework. And, if I sort of go through the key tenets of that, we have a very cash flow based approach to investing as opposed to reported earnings. We basically, our quantitative models screen on proprietary filters which revolve around valuations, revisions, momentum of earnings, as well as free cash flow characteristics. So looking for companies which can self-fund their growth. We're basically on the lookout for multi-year, high-quality, high-growth opportunities, quite often in the consumption arena in Asia ex-Japan. Many have spoken about, domestic consumption being the driving force of Asian economies, and this trend has really taken hold. So the process basically starts by filtering stocks which fit these criteria. But more recently, as I mentioned to you earlier, an element of top-down thinking has been key in terms of how we've evolved our process. So to give you an example, a key trend change in Asia that we've seen over the last several months is clear evidence of inflation amelioration. With the exception of India, which is a bit late cycle, India, I think, is one of the few countries where growth has been slowing, but inflation has still been sticky until very recently, where, of course, we had that element of surprise with the recent RRR cut. But the rest of Asia, we've seen, clear amelioration of the inflation trend, and both central bank policy action as well as rhetoric is aligning with that trend. And so we've been positioning our portfolios more into beneficiaries of that inflation unwinding trend, be it credit sensitives or interest rate sensitives, or just pure, companies which benefit from input prices coming down and, margin upside, which we expect to continue over the next 12 to 18 months. Maruti and Suzuki in India is one example, just to, dovetail this back to the Indian context. An element of top-down thinking in terms of global macro developments.
What about liquidity? What's the sense with how money will flow into risky assets for 2012?
Fund flow is, you get notoriously imperfect data on it, and you look at surveys and you look at EPFR data. I think there's an element of wishful thinking in terms of what people say. But what we can say, certainly based on what our client base tells us, is that relative to medium-term expectations that people want to be overweight on Asia ex-Japan, people are below that allocation. People are sort of neutral to below, and when I say people, I mean the end investor, the asset allocators, not necessarily dedicated fund managers in their respective asset classes. What has kept people back? And clearly the European crisis has kept risk appetite and animal spirits from coming back. I think the Chinese situation, in terms of the ability of the Chinese authorities to show that they have control over the economy, has been a factor holding people back. And I think once you get a sense that the Chinese are in better control and can manage this ongoing adjustment in the real estate sector there quite well, you will see the beginning of that shift in allocations away from the US, which was really seen as a safe haven last year, back into Asian equities. Because if you step back and look at the fundamentals, with ongoing austerity and deleveraging in Europe, you could be looking at a lost decade for Europe, stunted growth, very unsettled outlook with the debt crisis ongoing. And clearly the bright spot on a global macro canvas, Asia ex-Japan, stands out. So I think people are very comfortable with the idea of investing here, and we see this trend as continuing. On pure hard numbers, one of the reasons we increased risk and became more constructive in Asian equities, not madly bullish but more constructive, was that in 2011 you hardly saw any inflows. In fact, the numbers were about 15 to 16 billion US dollars of outflows coming out of Asia ex-Japan, at a time when valuations reached about 1.5 times price to book. Even India, which sort of starts from a higher base, reached about mid-teen kind of valuation levels. So we were more constructive on fund flow as well. And with the interest rate cycle ebbing and inflation unwinding, we expect Asian markets to start off on a much better footing and have a better year than last year.
Do you think Asia in some way is a little more insulated to what happens in Europe?
I don't believe that Asia escapes a global slowdown, and certainly we reached a tipping point last year in Europe. Even today it's not clear whether the European Union escapes recession in 2012. In that environment, you will have an element of shaving off of growth in Asia ex-Japan for global factors and for domestic reasons, like you've seen in India in particular. So I don't believe deep coupling it really works in a globalized market because of the transmission mechanisms I mentioned earlier: trade, fund flow, and investments. But what I would say is that in markets like India, where the domestic orientation really is what stands out, and they're not export-orientated economies, as you begin to see inflation come back under control, you see some improvement on the policy front, we do expect growth and investment sentiment to revive. By and large, we view the growth outlook to be pretty stable in countries like India. There were some cyclical headwinds, but we expect these to alleviate over the year. And India, in particular, I think would be a market that would show relatively limited degree of sensitivity to, let's say, a European slowdown.
Okay, does that also build a case where you might be looking at the force of liquidity or the resurgence of interest taking India and other Asian markets back to their 2010 peaks? Is that a scenario that's possible in 2012?
Look, it's difficult to say exactly how far we go in terms of markets, but we are more constructive. What I can predict with a reasonable degree of confidence is that Asia ex-Japan will outperform. Last year, both Asian FX as well as Asian equities really took a big hit, a savage derating, if you like. With markets like China reaching 7.5 times earnings, India mid-teens, multiples, which in the context of the growth outlook that you see in these two critical economies, they will remain the mainstay of the world economy. And those numbers are reasonably secure, even if you expect, the Reserve Bank of India talked about downside risk to growth and inflation being contained a couple of days ago. But even if you take a more cautious, circumspect view in a world that's slowing down, those numbers are reasonably secure, in the 6 to 8% growth rate. So I would expect the region to outperform quite clearly.